What's up, everyone? Alan Johnson with the AJ team. Question we got today was about a first-time home buyer. They're looking to purchase a property out in Loudoun County, and they wanted some information about an assumable mortgage. And this happens to be the second question that we've gotten about assumable mortgages. I think it was for a condo that we're listing in Fairfax. So a couple things I want you to be aware of. Number one, the two loans that are assumable in our area that we see most prevalent in our area are VA and FHA. So that's the start. If you're a seller and you have a VA or FHA loan with a very, very low interest rate, then that's at least the start of the conversation about whether you should market your home as an assumable mortgage, or whether as a buyer, you should be looking at that home as an assumable mortgage. All right, so next thing to think about, the seller must be open to it. It's a little bit different than what they're probably used to. They're used to someone purchasing a property, putting their own loan on it, then getting their money and then moving. This is a bit of a different process. This is the buyer assuming your mortgage, right? And for the buyers, what they don't necessarily think about is they have to generally cover the difference between what the mortgage is and what the market rate is. So say that you have a mortgage for $500,000 and the property's worth $700,000 and they want to assume your mortgage. Well, you're not likely going to let them assume your mortgage without making up the difference between what you owe and what the home is worth, which means the buyer has to generally come up with that difference, whether it's larger or what they're prepared for. That's a whole nother conversation. For as the seller, you got to understand that and be open to it. And as the buyer, you really have to make sure that you're prepared for it, right? The next thing you need to think about is, will the lender release the seller from the liability of the loan, right? So just say the original borrower or the new person who's buying your property, the borrower is purchasing your property. They give you the down payment. As a seller, I don't want to be liable for if they miss their payment or if they are in default, because that means that I'm the person that's responsible for it. Now, that's something that you can ask your lender up front if they would be willing to release you from the liability of the loan seller. And buyers, there ain't a lot of sellers out there that are going to allow you to take over their loan and they still be responsible for the way you pay it. All right, so that's something you need to think about. Next thing you need to think about, especially as the buyer, this doesn't affect the seller. The buyer, you have to go through the same lender if you're going to assume the loan, so you have to go through their process. That's a little bit different. You can't just go online, so that's something you need to call us so we can get the servicer from the seller, yada yada, right? And then there are three things you need to kind of think about. Number one, you need to confirm if your property is assumable. You need to talk to your lender about whether they will, as the seller, allow you to release the liability to the borrower. And then the buyers need to prep for the cost, right? Prep for the cost of the difference. It is advantageous if you can actually do it. It makes your home more marketable, especially in a rising interest rate environment. But the challenge we're finding is that, number one, a lot of agents aren't educated on it, because remember, a lot of agents came into real estate over the past 7 years. There was no one who was doing an assumable loan over the past 10 years, 7 to 10 years, because rates were low, right? Or they were refinancing. This was something that was done the decade before. So you really got to understand it. And then I think buyers and sellers just need a higher level of education, and agents who are working with these buyers and sellers need a higher level of education on how to do it, because it does take some work. But this ain't for, I would say probably 5 to 10% of homes, or maybe a little bit more, 12% in this area in the DMV would be something that, we need to have a conversation about. But it's worth having a higher level of conversation, because things are changing. And for sellers, you need every opportunity that you can to be able to sell your home for hopefully market value, because things are changing. And for buyers, the numbers are 50% of all people who own loans in the United States have a 3.5% interest rate or lower. 90% have an interest rate of 5% or lower. So if you can assume it, you should do it, right? So for buyers out there, look for homes that are sitting. Look for people that maybe you get with an agent and start saying, hey, I want to target these types of homes, and maybe you do some campaigns around targeting those types of homes. Realize that you don't have the pick of the litter, but there are some people out there who are just really just as much as the home is important, the interest rates and the finances are important, and that would be something that would work out for your mind frame or your mindset. All right, if you have any questions about this, give us a call. If you're thinking about selling your property and you have a FHA or a VA loan and you want to talk a little bit more about how this might be able to make your home more marketable, we can do a free 15-minute consultation. And if you're a buyer who's like, oh, no one told me about this and I kind of want to know about it, reach out to us and we can do the same for you. All right, you have the dream, we have the address. We'll see you soon.